Hey everyone, welcome back to Corporate Decoder, the place where we decode the financial secrets of big companies, and boy do we have a doozy for you today. This filing makes you wonder if they even had a plan to start with. This is Strategic Acquisitions Incorporated and their latest quarterly report, a 10Q filing, and the numbers here are, well, they're something else. Get ready, because we're diving into a company that seems to be struggling more than a squirrel in a hailstorm. So, what is this document? It is basically a quarterly checkup for a publicly traded company. It tells us how they're doing financially over the last 3 months and how their business is shaping up. This is for Strategic Acquisitions Incorporated, ticker symbol STQN. They're a Nevada incorporated company. Now, this report is for the period ending the 30th of September 2025. Let's start by peeking at their balance sheet. This is like a snapshot of what the company owns and what it owes at a specific moment. On the 30th of September 2025, they had cash of a measly $1,936. That might cover your lunch for a few days, but not much else for a whole company. For comparison, on the 31st of December 2024, they had a much healthier $23,281 in cash. That is a pretty dramatic drop. Their total liabilities were $4,887 on the 30th of September 2025. Now that might seem small, but remember that tiny amount of cash. And crucially, a big chunk of their liabilities, a whopping $95,621, was due to a related party back in December of 2024, though that amount is now zero. That is a lot of money they owe to someone connected to the company. They have common stock, and as of both the 30th of September 2025 and the 31st of December 2024, they had 6,675,000 shares issued and outstanding. This number hasn't changed. Their additional paid-in capital, which is money investors paid above the stock's par value, jumped from $353,736 in December 2024 to $457,056 in September 2025. That is a good sign, meaning they likely raised some more money from investors. But here is the kicker, the accumulated deficit. This is the total of all the losses the company has ever had, minus any profits. On the 30th of September 2025, it stood at a massive $466,682. And on the 31st of December 2024, it was $442,438. This means they've lost a lot more money than they've ever made. Their total shareholders deficit, meaning what's left for shareholders after liabilities, is a negative $2,951. So, technically, the company owes more than it owns. Now let's look at their income statement, or as they call it, the statement of operations. This tells us about their revenues and expenses over a period for the 3 months ending the 30th of September 2025, and also for the 9 months ending the same date. Their loan administrative service fees were zero. Yep, absolutely nothing, and interest income. Also zero for the 3 months ending the 30th of September 2025. However, for the 9 months ending the 30th of September 2024, they had a little bit of interest income, $43,671. But in 2025, for the 9 months, it is zero again. This company is not earning money from its core business, if it even has one. So, total revenues for the 3 and 9 months ending the 30th of September 2025 are each zero. In 2024, for the same periods, they had 16,177 and 43,671 respectively. This shows a massive decline in revenue generation. Now let's talk about their expenses, selling, general, and administrative expenses. For the 3 months ended the 30th of September 2025, it's actually a negative $3,347. That sounds good, right? But it is because they reversed an over-accrued professional fee. For the 9 months ended the 30th of September 2025, these expenses were $24,244. In 2024, for 9 months, it was a much higher $117,012. So they've cut down on their spending significantly, but that is usually a sign of distress, not growth. This leads to their income or loss from operations. For the 3 months ended the 30th of September 2025, they surprisingly show an income of $3,347. However, for the 9 months of 2025, they have a loss of $24,244. and in 2024, the 9-month loss was a staggering $95,906. And then there is interest expense. It is zero for the 3 and 9 months of 2025. Back in 2024, for the 9 months, they had interest expense of $18,804. This indicates they've paid off or significantly reduced any debt that was costing them money. So, what does all this mean for their net income or loss? For the 3 months ending the 30th of September 2025, they actually show a net income of $3,347. Again, that looks good, but for the 9 months of 2025, it's a net loss of $24,244. And for the 9 months of 2024, the net loss was a hefty $95,906. That is a lot of red ink. This next statement, the statement of shareholders' deficit, really lays bare the company's financial situation. Let's look at the beginning of the year. On the 31st of December 2024, their total shareholders' deficit was $82,027. Then for the 3 months ending the 31st of March 2025, they had a net loss of $25,044. By the 31st of March 2025, their deficit grew to $107,071. Another net loss of $2,547 for the next quarter. So by the 30th of June 2025, the deficit was $109,618. But then something interesting happened. They recorded a capital contribution of $103,320. This is essentially money injected into the company, likely from its owners or investors, to boost its equity. And that brings us to the 30th of September 2025, where their total shareholders deficit is now a much smaller $2,951. This capital contribution significantly reduced their overall deficit. Let's look at the previous year for context. At the end of 2023, their shareholders' equity was actually positive $42,687. But they racked up losses. A net loss of $43,450 for the first quarter of 2024. This put them in a deficit of $763 by the 31st of March 2024. Another loss of $22,508 in the second quarter. And by the 30th of June 2024, the deficit was $23,271. Then came a net loss of $29,948 in the third quarter of 2024, bringing their total deficit to $53,219 by the 30th of September 2024. Now, cash flow is king. This statement shows us where the company's cash came from and where it went. For the 9 months ending the 30th of September 2025, they used $29,044 in operating activities. This means more cash went out than came in from their day-to-day business. Interestingly, for the 9 months of 2025, there were no investing activities. But back in 2024, for the same 9-month period, they had a massive $1,374,691 provided by investing activities. This was from collecting a loan receivable. Financing activities also painted a picture. In 2025, they provided $7,699. In 2024, they used a huge $1,325,455. This was mostly due to repaying a note payable. So, the net change in cash for 9 months of 2025 was a decrease of $21,345. And for 2024, a decrease of $28,412. This explains why their cash at the end of the period was so low, just $1,936 in 2025, down from $23,281 at the start of the year. Digging into the notes, we learn that Strategic Acquisitions Incorporated, or ST2N, went through a significant change. On the 22nd of December 2022, they completed a reverse acquisition of Exworth Union Inc. They basically acquired Exworth Union, and Exworth Union became the operating entity. This Exworth Union business is about providing loans collateralized by digital assets like Bitcoin. However, and this is a big however, as of the 30th of September 2025 and the 31st of December 2024, there were no loans receivable outstanding and no digital assets being held as collateral. So their primary business seems to be completely stalled. And here is a red flag. The report states there is substantial doubt about the company's ability to continue as a going concern. This means they might not be able to pay their debts or keep their operations running for a reasonable period. They had a significant loss for the 9 months of 2025 and a very low cash balance. They plan to seek financing, but there is no guarantee they'll succeed. This section confirms what we saw earlier. On the 10th of July 2024, they collected a loan receivable of $1,374,691 and then repaid a note payable of $1,388,576. This activity seems to be historical. The key point is that as of the 30th of September 2025, there were no loans receivable and no digital asset collateral. This business, which was supposed to be lending against digital assets, currently has no such assets or loans. This note details a master loan agreement they entered into on the 14th of July 2022. This loan was repaid on the 12th of July 2024 for $1,388,576. This means a significant debt obligation has been cleared, which is good, but it also highlights that this activity happened in the past. This shareholders' equity section shows a history of stock issuances and exchanges, particularly around the reverse acquisition. It also mentions that on the 30th of September 2025, they entered into a loan cancellation agreement with Exworth Management LLC to cancel working capital loans totaling $103,321. This was treated as a capital contribution, which is why we saw that boost in additional paid-in capital and a reduction in the deficit. It is essentially owners putting more money into the company to keep it afloat. There is no provision for income taxes for the 9 months ended the 30th of September 2025 or 2024. This is because the company has consistently incurred losses, meaning they have net operating loss carryforwards that can offset future taxable income. They have significant net operating loss carryforwards, approximately $621,000 for ST2N and $388,000 for Union. However, a valuation allowance is recorded for the full amount of these deferred tax assets, meaning they don't expect to realize their benefit. In simpler terms, they have these losses on paper, but they don't think they will ever make enough profit to actually use them to reduce taxes. This is often a sign that a company does not expect to be profitable in the near future. We see Exworth Management LLC described as the controlling shareholder had advanced funds to the company. As of the 30th of September 2025, this balance is zero thanks to the cancellation agreement we just discussed. This cancellation of loans effectively converted personal debt into equity, which is a common way for struggling companies to shore up their balance sheets. This section is crucial. It highlights the risks the company faces. For the 9 months of 2024, one borrower represented 100% of their interest income, and one lender represented 100% of their interest expense. This is extreme concentration risk. If that one borrower had defaulted, or if that relationship with the lender had soured, the company would have been in serious trouble. Thankfully, as of the 30th of September 2025 and the 31st of December 2024, there were no borrowers or lenders, meaning this high-risk situation has apparently passed, but it also indicates the business has essentially stopped. Looking ahead, on the 1st of October 2025, the board decided to fund the company for the fourth quarter by selling common stock from Treasury. As of the 31st of October 2025, no restricted stocks have been sold yet. This confirms they are actively seeking to raise funds to continue operations. Now let's move to the management's discussion and analysis. This is where the company's leaders explain what is happening. They reiterate the reverse acquisition and that Exworth Union became their wholly owned subsidiary. They mention that prior to the merger, they were a shell company with no operations or revenue. The Exworth Union business is described as providing loans collateralized by digital assets. In the results of operations section, they acknowledge that interest income, their major source of income, was zero for the 3 and 9 months of 2025. They also explain the negative selling, general and administrative expenses for the 3 months of 2025 were due to reversing an over-accrued professional fee. This means they didn't actually earn income from operations or reduce expenses. It was an accounting adjustment. They state that their net income was $3,347 for the 3 months of 2025, but a net loss of $24,244 for the 9 months of 2025. They attribute fluctuations to the number of loans, interest rates, collateral value, and allowance for loan loss. The significant event of collecting a loan receivable and repaying a note payable in July 2024 is highlighted again, confirming past activity. This section is all about how much cash they have and how they plan to stay in business. As of the 30th of September 2025, they had only $1,936 in cash. They again mention the going concern uncertainty. They financed operations through private placements of equity, raising about $350,000 historically. They believe their current working capital is sufficient for the next 12 months, but if they can't raise more capital, they might not be able to execute their business plan. This is a very precarious position. Looking at the cash flow summary, the net cash used in operating activities was $29,044 for the 9 months of 2025. This is primarily driven by their net loss and changes in prepaid expenses and accounts payable. Investing activities are zero for 2025, but they had a large inflow in 2024 from collecting a loan. Financing activities in 2025 show a small inflow, but in 2024 it was a massive outflow, mostly to pay off debt. This section deals with internal controls over financial reporting. They've concluded that their internal control over financial reporting was not effective as of the 30th of June, 2025. The reasons cited are a lack of an oversight committee, insufficient accounting personnel for proper segregation of duties, and a lack of staff familiar with generally accepted accounting principles. This is a serious admission that their financial reporting processes are weak. And importantly, there were no changes in their internal controls during the quarter that materially affected them. This means the weakness persists. This part is usually less exciting. They state there are no legal proceedings. That is a positive. They also state there were no unregistered sales of equity securities. And finally, the exhibits. These are supporting documents. Notably, they have certifications from their Principal Executive Officer and Principal Financial Officer, which is standard. They also include a host of inline XBRL documents, which is how they submit their financial data in a machine. Readable format for regulatory purposes. So, what is the story here? Strategic Acquisitions Incorporated, or STQN, appears to be a company that underwent a significant transformation with the acquisition of Exworth Union. However, the core business of lending against digital assets seems to have stalled completely. With no loans or collateral as of the latest reporting periods, their financial statements paint a picture of a company with very little cash, significant accumulated losses, and a recent reliance on capital injections from related parties to keep its head above water. Their internal controls are noted as ineffective, which is a big concern. While they've cleared some debt and managed to reduce their deficit through capital contributions, the fundamental question remains, what is this company's actual ongoing business? With zero revenue from its described core operations for the period, and a clear emphasis on the past business activities. It is very hard to see a path forward without significant new strategic direction or a successful pivot that hasn't yet materialized. They are in a very challenging situation, and their going concern status highlights the immediate risks. Alright, that is our breakdown of Strategic Acquisitions Incorporated's latest filing. What do you think of these numbers and what they signal for the company's future? Drop your thoughts in the comments below if this analysis was valuable. Hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description for more community discussions. Thanks for watching. See you next time.